Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about Draftkings Inc. and they trade on the NASDAQ under the ticker symbol DKNG. Draftkings is a company I've talked about a number of times on the channel, and I thought it would be particularly pertinent to today's event as it is the Super Bowl, and Draftkings is one of, if not the largest sports betting platform in the United States. One of the reasons why I wanted to highlight the company today is because they also are going to be announcing earnings later this week. So that is expected to be February 18th, and I'm expecting that to be after hours. So the company, as you can see, has continued to lose quite a bit of money. And as we've seen the tech and high growth sector get pounded over the course of the past few months, you can see that they have unfortunately had quite a bit of that experience. So you can see that the stock was as high as around $28 a share before falling to where it is today, around $23.33. So you can see over the course of the past year, this is a company that did very, very well during COVID time period, during a high stimulus time period. And you can see that as the threat of oncoming rate increases has come about, as well as the fact that the company continues to hemorrhage money, then you can see that the stock has continued to fall down. Keep in mind that when this company went public via SPAC a few years ago, that they were coming public at $10 a share, and they have gone all the way up as high as $74 a share before coming back to current levels. So why is that? Well, if you look at the valuation of the company compared to their peers, then you can see that the company is currently trending about twice as high as the industry average in the price to sales ratio. Now, price to earnings they don't have because they are currently not profitable. In fact, not only are they not profitable on a trailing 12 months basis, but they are losing money hand over fist. You can see that from a gross profit perspective, they are currently sitting at about 40%. Keep in mind that this is a software platform and they are basically the marketplace for a lot of online sports betting. So the margins should be very, very good. However, you can see that from a net and operating perspective, they are blowing money like crazy. And the reason that they're spending so much money is so that they can grow their revenue. You can see in terms of revenue growth that it is coming in over a trailing 12-month basis, so year over year at 170%. So if we go in and we look at their cash flow, it looks quite good, or not their cash flow, but their income statement, it looks quite good, especially if we look at it on an annual basis, because you can see that the company is growing leaps and bounds on an ongoing basis. 2020, they had $615 million, and this week they'll be announcing the 2021 full numbers, and we're already expecting that to be much higher since the first 3 months alone, or rather the first 3 quarters, already covered the entirety of 2020 and beat it. So one of the things that is weighing very heavily on the stock is this selling, general, and administrative expenses. Now we're going to look at their investor presentation from Q3 momentarily, but it's important to note that the company is currently spending a significant amount of money going forward to be able to fund this growth. Now right now that's currently sitting at more than $1 for every dollar that they bring in. In Q3 of last year, it was looking right at 85 cents a share was being spent, or rather 85 cents for every dollar brought in was being spent solely on marketing budget. So the actual expenses right now is well north of $1 per dollar brought in, and that's just not sustainable. So there's a few different things that the company is expecting to utilize to grow, and I want to go to the investor presentation for that statement. So here I am in the presentation. You can see a number of their items here in terms of their growth. You can see that last year they launched in Arizona, Wyoming, Connecticut, and iGaming in Connecticut. And one of the things that we're really looking for the company to be able to grow is going to be able to leverage online sports betting in more states. Right now, that marketplace is just fairly limited. You're eagerly having these companies try and build up these marketplaces in states where it hasn't launched yet. And the further out they go, that's just additional money being spent in advertising on markets that they can't draw on at this point in time. So it's important to note that going forward that they have quite a bit that they still have left to get involved with. one of the things that I would highlight is here are some of their financials that we can utilize. I'll drop this presentation in the description so that you can take a look at it. But you can see that even on an adjusted basis, and this is where the company will make it look as good as possible, is that you can see that in 2020, for 9 months ended, or 2020, they had almost $1 billion in net loss. In 2021, that increased to nearly $1.2 billion. And that's what we see right here on the screen is this market right here, 1.1 billion nearly for a loss. So this is a company that I really like, but one of the things that I have some major concerns with is that while the comparison over time here looks great, and they are showing that they have the capability to bring in more money per user, and I think that their business model is great from a actual product perspective, I have major concerns on if the company is ever going to be able to become profitable. Now, if I scroll up above, you can see that one of the main things that the company appears to be losing out on is going to be associated with their stock-based compensation that you can see down here below. So while the company is absolutely hemorrhaging cash, like you can see here, in 2020, $500 million of that $1.2 billion net loss was due to stock-based compensation. So while the company continues to be non-profitable, their executives continue to take in multi-million dollar, in some cases $100 million compensation packages, despite the fact that the company is not doing very well from a profitability perspective. And that ultimately is going to impact the shareholders. Should they run out of cash, they're going to have to do another capital raise. And they've done quite a few year to date, or not 2022, but in the past year, they've done 2 or 3 different capital raises. As such, I do have major concerns about the stock. This is a company that I've been very bullish on. I like a lot of the products that they have. I think there is a huge benefit and a huge market that they can capture, but they have to stop spending so much, or at least figure out a way to capture market share, keep market share without absolutely blowing cash the way that they are. I don't have an answer for that. I'm open to feedback, but right now, I don't know if the company is going to be able to continue to function as is, utilizing their current cost structure. So as such, right now, I'm not rating Draftkings a buy. I do own Draftkings shares, but I'm not adding to that position at this point in time, and I don't intend to dollar cost average down at this point. However, should the earnings this week change my mind, I would be happily open to it, but I'm expecting another big loss quarter, as I imagine the Q4 numbers would have had some significant spending to prepare for the Super Bowl this week. Now, with the Super Bowl this week, I expect DraftKings to add additional shares as they are a major sponsor for the NFL. However, I still don't expect to see that additional revenue in the first or second quarter. So we'll see how they do, but all in all, the company has very high growth from a revenue perspective, and high interest rates will punish those companies from a investor shareholder perspective. So this is all just my opinion. I'm just some guy on YouTube, but if you find this content helpful, please leave a like and subscribe. Thanks. Talk to you later.